What if I told you one of the best performing stocks of the last decade isn't a tech giant, isn't an AI company, and doesn't even sell a product most investors get excited about? It rents out work uniforms, it cleans floor mats, it refills first aid kits, and over the last 10 years, it has crushed the S&P 500. Today we're going deep on Cintas, ticker CTAS, and I'll walk you through why this so-called boring business might be the kind of compounder serious investors quietly love and what the current pullback could mean. Quick note before we dive in. Everything you're about to hear is my own research and opinion, shared purely for education and entertainment. This is not financial advice. Stocks go up, stocks go down, and the decision to buy or sell is always yours. Cintas trades on the NASDAQ under the ticker CTAS. It sits inside the industrial sector, specifically specialty business services. It's a large cap name, worth around $70 billion, and while its revenue is loosely tied to the economy, the business model is unusually steady. We'll see why in a minute. My one-line thesis on Cintas is simple. It's a highly predictable, recurring revenue compounding machine, and the recent price pullback may be giving long-term investors a more reasonable entry into a business that almost never goes on sale. Let me defend that statement with the numbers. So what does Cintas actually do? At the core, Cintas is the largest provider of uniform rental and workplace services in North America. It serves more than 1 million businesses across the US, Canada, and Latin America. It designs, manufactures, cleans, and delivers uniforms, but it also runs 4 overlapping service lines: uniform rental and facility services, things like floor mats, mops, restroom supplies; first aid and safety, which is its fastest growing segment; fire protection, extinguishers, sprinklers, alarms; and direct sales of uniforms and gear. Most people see a Cintas truck and think uniform company. The reality is, Cintas is a subscription logistics business wearing a uniform company's clothing. Here's what makes this business special. Roughly 80 to 85% of Cintas's revenue is recurring. It comes from contracts that automatically renew week after week. Once a business signs on, switching providers is a nightmare. You'd have to resize every employee, rebrand all the garments, renegotiate prices, and reschedule deliveries. So most customers don't switch. Cintas keeps about 95% of them, and the average client stays for more than 10 years. That kind of stickiness is what gives this stock its compounder reputation. Now think about the physical footprint. Cintas runs 478 processing facilities and over 12,000 delivery routes across 330 cities. That's 48,300 employees handling pickups, drop-offs, repairs, replacements every single week. It even owns 5 of its own manufacturing plants, so it produces its standard uniform lines in-house instead of relying on third parties. This kind of route density is almost impossible to copy. A new entrant would need years of losses just to build the network. Looking at the revenue mix, uniform rental and facility services is still king at about 77% of sales. First aid and safety brings in nearly 12% and is the fastest growing slice. Fire protection adds another 8%. Direct uniform sales are the smallest piece. The gross margins on each of these are strong, roughly 49% for uniforms, 57% for first aid and safety, and around 47% for the rest. These are not the margins of a boring commodity business. Now let's get into the numbers, because this is where Cintas really earns its reputation. Revenue has gone up every single year, from $7.1 billion in 2021 to over $11 billion on a trailing 12-month basis. That's not flashy growth, but it's the kind of steady climb that compounds beautifully over decades. Net income tells the same story, up every year from $1.1 billion to nearly $2 billion. And profits are growing faster than revenue, which means margins are quietly expanding. And it's not just accounting profit. Cash flow from operations has nearly doubled in 5 years, hitting $2.2 billion on a trailing basis. Cintas is a real cash-generating machine, and that cash funds dividends, buybacks, and acquisitions. Compare Cintas to the broader industry, and the gap is huge. Gross margin averages around 47% versus an industry average of 35%. Net margin averages 16% versus less than 10 for the industry. So Cintas keeps about 60 cents more profit on every dollar of sales than its peers. That's a moat showing up in the income statement. Return on equity is the metric that great compounders all share, and Cintas is delivering over 41%. It's averaged about 37% for 5 years, and it's been climbing. Translation: for every dollar shareholders have invested, the company is generating 41 cents back, year after year. Free cash flow per share has been climbing steadily, partly because the business is growing and partly because Cintas keeps buying back its own stock. Shares outstanding have been quietly shrinking. The only thing to flag here is that the pending UniFirst acquisition will add about 14 million new shares, slightly diluting the share count for the first time in years. That's a known and intentional trade-off. For income investors, the yield looks small at about 1%, but the dividend itself has grown at 15% a year for the last 5 years. That kind of dividend growth, sustained, is what turns a modest yield today into a serious income stream a decade from now. Now let's talk about the moat, because numbers like these don't happen by accident. There are 3 big reasons Cintas is so hard to compete with. First, economies of scale, especially route density. 12,000 routes across 330 cities means every truck makes more stops per day, and every facility processes more garments per shift. The cost per delivery is structurally lower than any smaller rival can achieve. A new entrant would burn years of losses just trying to build a footprint that could compete. Second, switching costs. If you're a restaurant chain with 5,000 employees and you want to leave Cintas, you have to remeasure every worker, rebrand all the garments, renegotiate prices, and disrupt your delivery schedule. Most customers decide it's just not worth the headache. That's why retention sits around 95%. Third, brand and regulatory expertise. Cintas has a 95-year reputation as the safe choice in industries where one mistake is catastrophic. Hospitals, fire protection clients, OSHA-regulated workplaces. They don't want to gamble on the new guy. As regulations get more complex, that institutional knowledge becomes harder for new players to replicate. Let's zoom out and look at the competitive landscape, because something major is happening here. In market cap terms, this isn't really a fight. Cintas is worth nearly $70 billion. UniFirst, the third largest player, is about $4.5 billion. Vestis is just $1.3 billion. Cintas is roughly the size of its 2 largest rivals combined, times 10. The North American uniform rental market alone is about $21 billion a year, plus another $27 billion in workplace supplies, so plenty of room to grow. Vestis became the second largest U.S. pure-play uniform services operator after spinning out of Aramark in 2023. But the spin-off was rough. Vestis lost its financial support, lost route density, and lost customers. Many of those customers went straight to Cintas, the only company big enough to absorb them. Today, Vestis is shrinking, while Cintas is expanding. Their net profit margin is negative. Cintas's is 17.5%. And then there's UniFirst, the third largest player with about 250 service locations and 300,000 customer sites. On March 11, 2026, Cintas announced a definitive agreement to buy UniFirst for $310 a share, half cash, half stock. That's an enterprise value of roughly $5.5 billion. Interestingly, this is the third time Cintas has tried to acquire UniFirst. 2 earlier attempts in 2022 and January 2025 fell apart. This time it's official. Why does this deal matter? 4 reasons. 1. It lifts Cintas's market share from about 35% to roughly 46%, turning the big 3 into a big 2. 2. Combined customer count jumps to about 1.5 million, a 40% increase. 3. Combining delivery routes is expected to deliver about $375 million in cost savings over 4 years. And 4. Cintas now gets to cross-sell its high-margin first aid, safety and fire protection services to 2 million new uniformed employees. If the deal closes, it's a massive runway. The risk: antitrust approval from the FTC. If regulators block it, Cintas pays a $350 million reverse termination fee. Meaningful, but not a balance sheet threat. Now compare the stock performance. Over the past 5 years, Cintas is up over 100%. Over 10 years, it's up nearly 685%. UniFirst has barely moved. Vestis is down almost 50%. The market has already priced in the fact that scale wins in this industry, and Cintas has the scale. So if you're a long-term investor, the real question is, where's the next decade of growth coming from? Driver number 1. The UniFirst deal. Beyond cost savings, this expands Cintas's customer base by 40% and pushes it deeper into the medical scrubs market, which is structurally growing because of the aging population in the US. UniFirst alone generated $2.43 billion in revenue last year. That's immediate top-line growth the day the deal closes. Driver number 2. Cross-selling. Cintas already has a relationship with over 1 million businesses. Many of them only use one service. Selling them an additional first aid program or a fire extinguisher inspection contract costs almost nothing. The truck is already showing up. These are higher margin services, and they massively boost lifetime customer value. And the balance sheet is rock solid. Current ratio of 1.25 means short-term assets comfortably cover short-term liabilities. Debt to EBITDA below 1. That's exceptionally low for a company this size, and debt servicing eats up less than 5% of cash flow. So Cintas has plenty of firepower to absorb the UniFirst deal and keep investing without over-leveraging. All of this looks great on paper. But is the stock actually a good buy at today's price? Let's look at valuation 2 ways: price to earnings and discounted cash flow. Cintas trades at a price-to-earnings ratio of about 36.7 times, which is actually slightly below its 10-year average of 37.7. So compared to its own history, the stock is fairly priced. Not cheap, not expensive. The recent pullback pushed it from the 50s back to the average. It's not a deep value play. Premium businesses rarely are. For the discounted cash flow, I'm using the company's own 5-year EPS growth of about 16.8% and a blended analyst projection of about 12.3% going forward. Discount rate of 6.34%, operating cash flow of $2.2 billion, and roughly 405 million shares outstanding. In the base case, assuming 15% free cash flow per share growth for 5 years, then tapering to 12.7%, then 4% terminal. Intrinsic value comes out to about $174.69 per share. The current price is $175.90. So in the base case, Cintas is trading essentially at fair value. About a 0.7% premium. That's not a screaming bargain, but it's a reasonable entry for a long-term holder. If we get more conservative and just use the 12.67% analyst growth rate across the board, which is more cautious, intrinsic value drops to about $155.77 per share. That puts the stock about 13% above fair value. So the takeaway is, Cintas is not cheap. It's either fairly valued or slightly expensive, depending on your assumptions. For long-term compounders like this, fair value can still be a perfectly fine buy. Just don't expect a deep discount. No stock is a slam dunk, so let's talk about what could go wrong. First, cost inflation. With 48,300 employees on payroll, Cintas is exposed to wage inflation. Healthcare benefits costs jumped 5.8% year over year. About 900 employees are unionized, and rising diesel prices, driven partly by Middle East tensions, directly raise transportation costs. If wage inflation outpaces pricing for 24 months, operating margin could compress by about 100 basis points, and FY 2027 operating income could drop by $126 to $190 million. That's a 3 to 4% hit to EPS. Second, the UniFirst deal could be blocked. Merging the number 1 and number 3 players raises serious antitrust questions. The Federal Trade Commission has to sign off. If regulators kill the deal, Cintas owes UniFirst a $350 million reverse termination fee, and the growth story tied to this acquisition disappears. The core business still works, but a lot of the medium-term upside is tied to this merger going through. So let me pull all of this together. Cintas is the dominant player in a sticky recurring revenue business with 95% customer retention. It's growing revenue, profits, and cash flow every single year. Margins are double the industry average. Return on equity is over 40%. The balance sheet is conservative. A transformative acquisition is on the table that could push market share to nearly 50% and unlock 1 million new cross-sell opportunities. The pullback has brought the stock back to its long-term average valuation. The trade-offs are real: wage inflation, diesel costs, and FTC risk. But the long-term thesis is clean and well-defined. My personal take: Cintas isn't a stock you buy hoping to double in a year. It's the kind of business you tuck into a long-term portfolio and let do its thing for the next decade. If the UniFirst deal closes, this story gets even more interesting. If it doesn't, the underlying business is still one of the best in industrial services. As always, do your own homework, size your position based on your risk tolerance, and never bet the farm on one ticker. That's the full Cintas breakdown. If this was helpful, smash the like button, hit subscribe, and drop a comment telling me which stock you want me to break down next. I read every comment. Stay curious, stay disciplined, and I'll see you in the next one.